So having looked at the income from continuing operations, now let's look at income from discontinued operations. Companies sometimes decide to discontinue or sell part of its business, which is very common for firms. Examples are, for example, Google sold its Motorola business smartphone subsidiary to Lenovo in 2013. Pfizer sold its nutrition business to Nestle in 2012. Campbell Soup sold its European single meal business to Super Investment. So it's very common for firms to discontinue or sell part of its business. And income from discontinued operation is disclosed separately from income from continuing operation. This we already mentioned. And there's three, when the firm has any kind of those cases during the year, there are three accounting questions. The first question is when to recognize something as discontinued operation. And then once we decide to recognize something as discontinued operation, the next question is how to measure the income or loss from that operation and how to disclose it on the financial statement. So let's first look at when to recognize something as discontinued operation. So to be recognized as a discontinued operation, some criteria needs to be met. A component of an entity or group of components has been sold or disposed of, or is considered held for sale. So what do we mean by components? What constitutes a component of an entity? It should be activities and cash flow that can be clearly distinguished from the rest of the company. You need to be able to separate those activities and cash flows. And then if the disposal represents a strategic shift that has or will have a major effect on a company's operations and financial results, so the impact should be major. And then we separately disclose it as an income from discontinued operation. So that is when. And then this second point is subject to management judgment. So how to disclose discontinued operation on the financial statement? So examples are, let's refer to the handouts. So let's look at the five firms' income statement. Please take 1 minute and go through those income statements. And can you tell me which firms have discontinued operation? Does Starbucks has discontinued operation? No, the Starbucks doesn't. No discontinued operation. The Starbucks doesn't have discontinued operation. How about Pfizer? Yeah, as you can see here, discontinued operations. So this part. So Pfizer does have discontinued operation. Apple doesn't have discontinued operation. Intel doesn't have discontinued operation. How about Walmart? Walmart does have discontinued operation, even though it is only one line. But we can already see it here. So the firm does have discontinued operation. No matter if the firm is just grouping everything just into one line, or if the firm is disclosing it in more detail, as what Pfizer is doing here. But in both of those cases, both Pfizer and Intel, they do have discontinued operation. Oh, sorry, both Pfizer and Walmart. So what can you observe from those examples? The first observation is discontinued operation are reported separately from continuing operation. So this we have already mentioned several times in this class. And then another thing, which is sometimes can be kind of omitted, but which is also very important. So this is something that sometimes people do not pay so much attention to, but it is very important that discontinued operation needs to be reported net of tax. If you go back to look at those examples, both of those numbers, in both of those cases, no matter in Pfizer or in Walmart, the discontinued operations are reported net of tax. And then we need to separate income tax effect with income statement components that create those effects. So for income tax, income or expense, that is associated with income from continuing operation. And then for income from discontinued operation, it has its own income tax effect. It needs to be separated from those income tax from continuing operation. And this is called intra-period tax allocation. So it just intra-period tax allocation just means that we need to separate income tax effect. We need to associate income tax effect with the income that generates those effects. And how to measure income or loss from this continued operation? There are two situations. The first situation is if the operation has been sold, so we have already discontinued it in the current period. And then the second situation is the operation has not been sold. So we haven't discontinued it yet, but it is considered held for sale. We haven't discontinued it yet, but we plan to discontinue it in the near future. And for the first situation, if the operation has already been discontinued, what we do is we take income or loss from operation. So whatever that operation generates during the period, and plus gain or loss on disposal. So first of all, how much does this operation generate during the period? And then how much do we get, no matter whether it's gain or loss, from selling, from disposing that operation. And then for the second situation, so the first part is income or loss from operation. How much does the operation generate during the period? And then the second part is impairment loss. We haven't disposed this operation in this under this situation. So what we do is we need to estimate what is the possible loss that may happen if we dispose it. So the impairment loss here is basically if we estimate that in the future, what we can get from disposing this operation is more than the current book value of the operation, then we don't need to do anything here. We don't need to recognize impairment loss. However, if we estimate that what we're going to get in the future from disposing this operation is less than the current book value of the operation, we need to calculate our impairment loss, and we need to recognize this impairment loss immediately in the current period. And this impairment loss is basically fair value of this operation minus cost to sell, which is basically what we estimate that we can get from disposing this operation minus the book value of the operation. So let's look at 3 examples which illustrate what we do under different situations. The first example is if we have already sold this operation in the current period. So company A completed the sale of its semiconductor business for 10 million. The business qualifies as a component of entity according to GAAP. The book value of the asset of the segment, so book value is 8 million. Operating loss of the segment during 2013 is 3.6 million. Pre-tax income from continuing operation for the year total 5.8 million. Income tax rate 30%. So please prepare the lower portion of the 2013 income statement beginning with pre-tax income from continuing operation and ignore EPS disclosure. Please take 5 minutes, try to work on it on your own, and you can pause your video for now. So this is how it looks like. We begin from income from continuing operation before income tax, which is 5.8 million. And then we take out income tax expense, which is 5.8 million multiplied by 30% tax rate. This is how you get this number. Oh, sorry. This is how you get this number. And then income from continuing operation is you take 5.8 million minus 1.74 million. That is gives you 4.06 million. So this is the continuing operation part. And then for discontinued operations, loss from operation of discontinued components. So first of all, the operating loss of the segment during the year, just from operation, we have a loss of 3.6 million. And from disposal, both of those are associated with this operation. So from disposal, we sell it for 10 million. And then the book value is 8 million. So we made 2 million from selling this operation. So the total of this is negative 1.6 million. And then negative 1.6 million multiplied by 30%. So that is the tax benefit we're going to get. That is 0.48 million. So as you can see here, we have negative 1.6 million. The loss from operations of discontinued components. And then we have an income tax benefit, which is associated with this loss of 0.48 million. So the loss on discontinued operation net of tax, that is the difference between these two. And that is negative 1.12 million. So this part is from discontinued operation. And if you take income from continuing operation, which is A, plus loss on discontinued operation, A plus B, that will give you 2.94 million. That is your net income. So this is the first example. And then let's look at another example here. This is the situation if it is held for sale and we expect gain from sale. Please take 5 minutes, work on this example, and you can pause your video for now. So in this example, the semiconductor segment was not sold, but was held for sale. The estimated fair value of the segment, net cost to sell is 10 million. And then the book value is 8 million again. Please prepare the lower portion of the 2013 income statement. So here is the answer. The income from continuing operation is the same as before. And the only difference is for discontinued operation. So this part, we have from operations, we still have negative 1.6 million loss. And so in this situation, the operation hasn't been disposed yet, but we do need to recognize impairment loss if there's any. So is there any impairment loss that we need to recognize? So the answer is no. Why? Because the fair value minus cost to sell is 10 million and the book value is 8 million. So if we are going to dispose it, we're going to recognize again. And then in this situation, we don't need to recognize impairment loss now. This is out of the conservatism. So if we expect to have a gain in future disposal, we don't need to recognize it now. But if we expect there's going to be a loss in the future from the disposal, we need to recognize it immediately. This is out of conservatism. So impairment is 0 in this situation. So the total is negative 3.6 million. And negative 3.6 million multiplied by 30%, that will give you 1.08 million. So we have 1.0 million income tax benefit. And then the difference between these two is negative 2.52 million, which is loss on discontinued operation. And again, net income is the your income from continuing operation plus loss on discontinued operation. That is your net income. So this is the second example. And now let's look at the third example. The operation is held for sale, but we expect a loss from sale. Please take 5 minutes, try to work on this example. You can pause your video for now. So in this example, the fair value of the segment's asset net cost to sell is 7 million, but the book value is 8 million. So what do we do now? The first portion is the same as before, and then the second portion from operation, we still have negative 3.6 million loss, and then impairment. So in this situation, 7 million is the expected what we are going to get from disposing this operation, but the book value is 8 million. So the difference is 1 million, and we need to recognize it immediately. So the total is negative 4.6 million. And then negative 4.6 million multiplied by 30%, that is going to give you 1.38 million. So loss from operation of this continued component is negative 4.6 million. And then our income tax benefits is 1.38 million. So the total of these two is 3.22 million. And that is in loss on discontinued operation. And your net income is the sum of these two, A and B. So this is the third example regarding discontinued operation.